Hello, welcome to Roadmap to Wealth. My name is Carlos McWhorter, CPA, and in this video, I'm going to talk to you about yield to cost. A lot of us focus on dividend yield when we're looking at stocks, but you need to focus on yield to cost, and I'll show you what that is and how to focus on that. I will also give you some examples on how Warren Buffett has used yield to cost and how it's impacted his portfolio with some of the stocks that he's purchased in his hedge fund. And I'll give you an example of what stock that I have in my portfolio and how the yield to cost impacts the performance of that stock. So we know what dividend yield is. It's the percentage of dividend that you receive compared to the purchase price of the stock. But once you buy the stock, then the dividend yield really doesn't matter. What matters then is yield to cost. So let's look at what yield to cost is. Yield to cost is a measure of dividend yield calculated by dividing a stock's current dividend by the price initially paid for that stock. So once you pay for the stock and the dividend continues to go up, your yield to cost will go up, and that's what you need to focus on. If you own a stock and you look at like the stock ticker and you see what the dividend yield is, that dividend yield is looking at the current stock price, not the price you paid for it. So you should be concerned with the yield to cost. Let's look at a few of Warren Buffett's purchases and let's look at the dividends at the time that he purchased it to where it is now and see what his current yield to cost is. Okay, one of his more famous purchases and larger holdings in his portfolio is Coca-Cola. Warren Buffett bought Coca-Cola in 1988. At the time, Coke was $2.79 per share. The dividend at the time was about 7 cents per share. So that's in a year's time, if you held that stock, you got 7 cents of a dividend. That was a 2.5% yield, modest yield, or I should say solid yield. 2.5% is a solid yield. Over this time period from 1988 to 2022, 34 years, that dividend grew every year at an average rate of about 5 cents per year, giving what I call dividend glory. Right now, Coca-Cola is paying a dividend of $1.76 per share. That is a yield to cost of 63%, meaning for that share that he bought for $2.79, he gets $1.76 per share. You're not going to see many stocks that you can buy that are yielding 63% dividend, but you can get there by buying a stock that has great cash flow, like Coca-Cola. They're growing their dividend every year, and over time, that dividend will grow and you'll have a yield to cost or a dividend yield compared to what you paid for the stock at a very high rate. In this case, 63%. Now let's look at an even more, a greater amount of yield to cost in his portfolio. Looking at Johnson & Johnson. Buffett bought Johnson & Johnson in 1985 for $3.29 a share, getting an 8% dividend. In 37 years, that dividend grew over 5,000%. That dividend went from 8 cents per share to $4.52 per share. That is a yield to cost of 137%. Now you might hear the term dividend growth strategy, and this is exactly what that is. Of course, when you buy the stock, you're hoping that the stock goes up, and Coca-Cola and Johnson & Johnson has definitely done that. The stock itself has gone up, but the dividend growth is what we're focusing on in this video. And we're looking at 137% yield on the stock. So it is better to buy a stock that say has a 1% yield or a 2% yield, but they're consistently growing that yield every year versus buying a stock that has say a 7 or 8% yield, but they're not really growing that dividend. Even if they were to continue to pay out that consistent dividend that's flat, you want the company that's growing their dividend. You want a company that has a strong cash flow that continues to grow so that they continue to grow their dividend. So over 5, 10, 15 years, your dividend yield will be much higher, hopefully much higher than that 8%. So I want to show you an example of a stock that I own, Dick's Sporting Goods, and how that dividend increase over a short period of 5 years has increased my yield to cost. So let's look at it. Dick's Sporting Goods, I bought this stock back in 2018 for about $32 per share. Right now, the stock is at $111. So capital gains was great. It went up 249% since 2018. So that's good gains on that stock. At the time, I was getting a 90-cent dividend. So that was about 2.8% dividend yield. Pretty solid yield. Now, looking at the dividend growth, in 2019, it went up to $1.10. That was a 22% increase in the dividend. 2020, $1.25. That's a 14%. These are really great dividend increases. In 2021, it went to $1.60. There were 2 increases in 1 year in 2021. So that was a 28% increase in 1 year. In 22, $1.95, another 22% increase. So overall, that is a 116% increase in the dividend that I received from that purchase in 2018. So my yield to cost was a dividend yield when I bought it. It increased every year. Now, in 5 years, I have a 6.1% yield to cost. I get this $1.95, not off of the current stock price, off of the price that I bought it in 2018, which is $32. So I get 6% yield on that investment. So I know we look at some of the big examples in the hedge fund managers and we see how long they've held stocks, and it seems like it's unattainable, but it's not true. It is attainable if you buy quality companies that have an advantage, that continue to grow their dividend because they have the excess cash to give to the shareholders. So in my opinion, it is much better for me to buy a stock that had a 2.8% dividend yield and allow that stock to grow while I'm getting a 6% yield on my investment, versus say in 2018, I might have bought a stock that had a 6% yield at the time, but maybe they weren't growing that yield and I could still be at 6% or maybe a small increase of 6.5 or 7%. Looking at Dick's Sporting Goods, it is likely that they will continue to grow their dividend, looking at their cash flow. Now, it's not likely that they will be growing it at this rate for, I say, the next 5-10 years. This, I will say, is excellent and not normal dividend growth. I would expect this dividend growth to continue, but not at that rate. So I would say I expect a 10%, maybe 12% annual dividend growth rate over the next few years, which will still continue to grow my yield to cost at a great level. So no complaints here. On top of that, like we said, the stock went from $32 to $111. So that's the concept of yield to cost that I wanted to show you, so you can incorporate that type of thinking in your investment decisions. When you're looking at dividend yield, don't just look at the percentage that it's paying at the time. It's good to know that. Of course, you want to evaluate your return on your investment, but look at the cash flow statement and make sure that company is continuing to grow their cash flow, so you can see that how likely it is that they'll continue to grow that dividend. This way you can maximize your yield to cost on your investment and collect those dividends and grow your passive income at a great rate. If you found this video helpful, please consider liking this video and subscribing to my channel. I have more videos coming for you. Also, share this to an investor that needs to hear this information. This has been Roadmap to Wealth. Thank you. My name is Carlos McWhorter, CPA. See you in the next video.